A very warm welcome to everyone who has joined us today from across the world. My name is Deepa Thakkar and I manage NRI products for HSBC India. I will be your host for the evening and I am delighted to welcome you today to our special initiative, Life Beyond Borders. While HSBC India is continuously working towards making your financial journey better, we have been taking customer feedback on what more value can we add to their lives. To bring beyond banking to our customers and stay engaged with you, we have launched this specially curated series of Life Beyond Borders. We have received an overwhelming response for the series and have 1,000 plus clients joining us every month from across the world. Today's webinar is on financial wellness basics for mariners. Last year, more than 250,000 Indian seafarers were employed on domestic or foreign vessels, and it is on the rise for this year as well. We all understand the challenges to mariners are unique. The extended periods away from home and the irregular pay schedules makes the financial stability and wellness a crucial aspect to their lives. A sound financial strategy will support you to have the stability and calmness to navigate life's unpredictable tides. There are a lot of investment avenues. The correct financial strategy can support you to navigate and anchor the intricate lighthouse of financial planning. To help you understand and decode the pathways to financial wellness for mariners, I am pleased to welcome my colleagues Rajat Handa, our Senior Vice President and Head of Distribution, HSBC India Mutual Funds, and Nidhi Shah, Vice President of Market Insights from HSBC India. They are our experts in financial management and market performance. A very warm welcome, Rajat and Nidhi. Thank you so much for taking out time today to provide expert advice to our mariner customers and help us understand the best financial avenues for them to sail smoothly. Audience, please do keep sharing your questions in comments and I will take it up with Rajat and Nidhi. I will try and answer as many questions as we can. Without further ado, welcoming Rajat and Nidhi to talk to us on financial wellness for mariners.
Good evening, everyone, and welcome to the webinar. I'm glad to share as Deepa talked about financial wellness. So this is something that we have heard a lot about, what is financial wellness? And it's a terminology that we've been reading quite often. But if we have to really understand what financial wellness is and why does it really help us in achieving our goals, I'd like to just kind of break down in terms of why financial wellness is important. So just to kind of start with why exactly that we talk about that financial wellness is important. The three goals that we really try and achieve with financial wellness is achieving goals. When we really talk about financial wellness, it's not really about securing a present, but it's also about securing a future and really preparing for any unforeseen events for that matter. So the two things that financial wellness helps us achieve is achieving financial goals. Goals could be any long term, short term. It might be some unforeseen incident that we really want to take care of. That also helps with achieving financial wellness. The other thing that financial wellness really helps us do is disciplined and goal focused investments. Now, when we talk about disciplined and goal focused investments, it's really important that we're spending or investing our money in the right kind of assets. And it really helps us in building the kind of wealth that we really want to achieve our goals with. The other thing it's very important is in terms of beating inflation. So if we are going to really have a very clear goal and we have a very clear journey mapped towards achieving that goal, and we have a very clear target in terms of where we have to reach, we will make it disciplined, we will make it focused, and we will see that inflation doesn't really eat into our wealth creation. So these are the three things which would be very specifically achieved when we actually doing wealth creation, and that is wealth financial wellness is important. The next thing, if I have to really talk about in terms of, so this is what we have already done in terms of understanding why financial wellness is important. So the three pillars would be achieving your goals, building up any corpus that we need for unforeseen incidents as well as disciplined and focused investments. The other things that we really talked about when we were talking about financial wellness was goals. Now, we sometimes really have a very narrow view of goals. It might be just purchasing house, or it might be just building a corpus for future education. But the way each and every individual existence is different, each and every individual aspiration is different. You have varied financial goals. It can be travel, it can be taking care of elders, it can be even doing charity and donation, or it can be even taking a break or a sabbatical and doing career development in a different line of action altogether. So financial goals can be varied, they can be short term, they can be long term, but the idea is to really have a clear understanding of what financial goals that you're looking at in terms of planning. Now, once we've understood why financial wellness is important and what kind of goals that we are looking at, it's important to understand how do we actually do that. The first step, I mean, it's a very easy way to build a financial goal plan. And while we think it's something really complicated, it really needs a lot of information. It starts with very basic few steps. So first, if I have to talk about, it talks about, where do you currently stand in terms of your assets minus your liabilities. So basically, where is your net worth? The second thing which we talked about in the previous slide is just talking about what are my goals. They can be long term, they can be short term. You can also have like a provision for unforeseen incidents also for that matter. Then you also need to understand how do you factor in inflation. Now, inflation is something which we'll be really talking about later, but it's something which determines the purchasing power of money. So when you're investing, not considering in inflation might be a big folly. So we really need to look at how inflation can erode my savings. The other thing, which is also very important when we're talking about investments or saving, is how much risk can I take? Each and every investment or asset that you're looking at has a perceived risk attached to it, along with obviously the returns that you look at it. So to understand what is the risk comfortability of each and every individual is very important. I might be wanting the highest return, but if I'm not really ready to take that kind of return that gets associated with that asset, then it would actually lead to, disappointment. So the idea is that we understand the return that I can look at the same point of time, I can understand what risk is that I'm comfortable with. Then once we have figured these steps, I know where I stand in my assets, where I need to reach, what is the inflation, what is the risk. The next possible step will obviously be the asset allocation, or what kind of asset class suits me. If you're going to try to decide the asset class before knowing what is your risk profile, before knowing what is your long-term goal, or before knowing what is your net worth currently, it really wouldn't help. So all these steps need to be followed somewhere in a sequential manner. So the investments and the time is invested in the correct asset class as per your requirement, as per the inflation prevailing, and as per the risk that you're comfortable taking in. Then this is something very interesting. While we talk so much about financial wellness, while we talk so much about investment, etc., a lot of times there are also situations where we have a lot of these myths associated with financial wellness or investments for that matter. So I'll kind of, address and try and address some of them. So the first one that we talk about is, when is the right time to start investing? Or maybe I should start investing only, when I've reached a certain age, or when I'm approaching retirement, or when I need to do long-term planning. The right answer is there is no correct time, correct age, or correct stage of life in terms of goal planning. The more aware you become, the sooner you become aware in terms of what goals you need to plan for and how can you achieve financial wellness, is the right time to start. At the same point of time, there might be situations also where people think that the markets are at this situation, whether it's the right time to go ahead with it. But financial wellness, financial goal planning is irrelevant of how much money do you have, at what stage of career you have, or where the markets are. It's a process that has to be begun. The second myth I would address is talking about whether savings and investments are the same thing. Now, again, though the words are pretty similar, and you could say, okay, saving is as good as investment, there's a very stark difference between the both of them. Savings is basically keeping some money aside from your regular income and not really investing in something. But investing is when you use that savings into a proper asset allocation, and which is something guided by your goal planning, and it's somewhere part of your entire final financial wellness planning. You definitely can kind of think of them as somewhere similar, but they're definitely not similar. Investing is something actively that comes after saving. Just saving without investment cannot really help you achieve your goals. So investment is something that very naturally should follow saving, and saving without investment might be actually quite futile. So without taking much of time now, I'll invite Rajat to kind of share the remaining two myths. So he'll take you through the same. Thank you so much.
Thank you, Nidhi, and thank you, Deepa, for having me on this fabulous webinar. I think it's a lovely initiative, and I warm welcome to all our customers across the country. And let me continue on the remaining two myths that we have. It's all about shattering myths and exposing our customers to the reality and the myths. One of the favorite myths which I've come across, very popular myths, is that it's a one-time exercise. You're done with it. Financial wellness is over. It's a one-time Excel sheet filling exercise. You don't need to review your financial plan. One very old adage which all of us are aware of is that change is the only constant, right? Tomorrow can be different from today. Our financial situation can change. Our life stages can change. Emergencies can come in, God forbidding. So I think financial wellness is not a one-time exercise. It just doesn't need to be done once. It's something which you need to review. You need to be on the job. And for that, thank God for small mercies. We have experts and financial planners who can help you with. So I think that's something which we should consider. And one more myth which is been there since time immemorial is that it's a chicken and egg story, right? So financial wellness can only be done once somebody has created a certain amount of wealth or corpus. It's a chicken and egg. If you don't have financial wellness, how do you create that quantable and amazing or aspirational sum of money or pot of money? So I think financial wellness is not for the wealthy. Financial wellness is not for somebody who's established and now you need to manage that accumulated pot of wealth. Financial wellness starts as early as probably you're just starting and you're getting your salary, or you're starting with the revenues of your business, or if you are self-employed, or whatever stage of life you are. As soon as you're eligible and you think that you understand finances, you need to take that first step towards planning and being aware of, like what Nidhi said, your goals are, your risk appetite is, and the cash flows which you will receive and what kind of investments you can make. So that's a little bit about the four myths which Nidhi started and I probably summarized. Nidhi, we can go to the next slide. Yeah. So we are done with the myths. Now comes the reality. Ladies and gentlemen, this is a reality in front of you. The words on the top are not typical Friday weekend kinds. It says inflation can be killing. We want to keep the mood slightly light here. But without trivializing the issue, inflation is a double-edged sword. It does defeat the purpose of wealth creation. It does defeat the purpose of saving and investing. Nidhi was just explaining to you the difference between saving and investing. And she did touch upon and allude to this demon called inflation. So inflation is nothing but, in very simple terms, how dear your money gets. If you're able to buy something for $100 today, probably with prices going up, you'll be able to afford the same thing, the same good, the same service at maybe 2 times, 3 times the cost in 10 years. And this is a reality check. So if you see the annual expenses which an individual is incurring, and this is just an illustration, at 25 years of age, that would probably be somewhere about close to 18 lakhs. Let's take that as a ballpark figure, considering the rentals and the lifestyles and the new phones and cars that all of us and the new generation, the Gen Z, is very, very passionate about. So I think 18 lakhs per annum today, if you want to afford the same lifestyle, if you want to afford the same kind of privileges or luxuries, then probably at the end of 60 years, this, which is another 35 years from now, this same goods and services will come at about 1.4, 1.4 crores or thereabouts, right? And we are saying that inflation is merely at 4%, which unfortunately is a very, very conservative estimate. I can tell you that over the last 20, 25, 30 years, actual inflation, because there are two kinds of inflation. There's an inflation which is a wholesale price index, and there's an inflation where consumers like you and I are impacted. That basket of goods, I think that inflation is growing at almost double the number which is put here. That inflation is probably higher than 6 to 7%, which means that things will become unaffordable if you are not able to invest your money properly, keeping in mind the basic target. And that basic target, ladies and gentlemen, should be beating, not matching, beating inflation. And that's just the basic target. Let's go ahead, Nidhi, with the next one. Okay, so on the left-hand side, you're seeing some stages and some, it's a reiteration of some goals which Nidhi alluded to earlier. So you can see you have children's education, you have retirement planning, you need to save on the long term. There is healthcare required for the elderly. And when we become, senior citizens, and health, of course, in India, healthcare is very expensive. And I'm sure, in other countries as well. And of course, then you have something which is becoming very, very critical now, the intergenerational wealth transfer, which is passing on wealth to your next generation. So all these goals are important and they are staring us in our faces. Now, if you have a look at this graph on the top, it says start early. And there's a question mark, right? So the early bird gets the worm. What is the worm here? The worm here is, we've given you two examples here. There is a story of Priya and there's a story about Rajan. Priya is probably benefited with some good advice. So she starts very early, maybe probably somewhere around 23, 24 years of age. And she understands the nuances and the requirement of financial planning and wellness. So what she does is she starts investing very early. Yeah. And you can see what happens to her wealth when she probably turns very, very close to retiring. At the same time, Rajan, a friend of hers, does not pay too much heed. For Rajan, probably there are other pressing demands and he is more focused on spending, on expenditure, maybe the next iPhone, maybe the next model of the car, maybe a movie every weekend. And maybe, what he feels is that investing and planning and saving can take a backseat, right? Which usually happens with youngsters, with a lot of people. I don't blame them. But then there is a 3-word phrase which I think all of us should remember. There is a very sharp cost of delay. And that cost of delay can make a mammoth difference between somebody accumulating 1.2 crores and somebody accumulating just about maybe 60% of 50, 80%, 70% of what that is. So 70 lakhs. So you've got Rajan, who's accumulated 70 lakhs, and you've got, Priya, who's accumulated 1.2 crores. So those many years, that lead time, the earlier you understand financial wellness, I think for all our younger siblings, our children who are just about to step into their careers, I think this should be one of the biggest and the most significant learnings that we should impart as parents and as elders. Yeah, Nidhi, let's move on. Okay, so with that, I think we've covered some of the basic tenets of financial wellness. The fact that we need to identify our goals, we need to understand the risk tolerance. Everybody is different. Everybody has a different heart to absorb ups and downs. And also the fact that we demonstrated that there are some myths about financial planning and financial wellness, which we should understand and discard very early in our lives. The cost of delay can be as killing as the impact of inflation, which we demonstrated in 2 graphs. And I think the cost of delay, because everything compounds in life, our problems compound, our happiness compounds, and our wealth also compounds. And if I take you back to probably 6th grade, 7th grade mathematics, the compound interest formula, if you remember, the only thing which is raised to the power is t, which is time, right? So if you are able to get a grip on time and you start early, then it can be a sky difference between what you can create in terms of wealth planning and where you end up in finally. So that was a summary of what we did. Maybe the next 5 or 10 minutes, I intend to share our thoughts on markets. I plan to give you an overview on what has happened in equity markets, in debt markets. We'll not make this a very, very long, complicated session. The idea is that We give you a snapshot and overview of what has transpired in capital markets in India, because I'm sure a lot of you would be investing. Just a small disclaimer here before we delve into market outlook. Ladies and gentlemen, we appreciate the fact that you may have a lot of questions. This is just an information session where we are trying to give you some views and some opinions about the importance of financial wellness. And we are trying to also give you a perspective on how the markets have behaved, which I will share with you. This is not a session where we talk about products. This is not a session where we can talk about specific requirements which you may have. If you have such requirements, if you have certain questions on certain products and services, well, I think there's a number at the bottom of your screens. There's a ticker which is running. Please reach out to the bank. Please reach out to our colleagues in HSBC. If you are having relationship managers, reach out to them. They're always at your service. And I think it'll be more meaningful for you to have one-to-one discussions on product related and specific queries. Yeah, so that's my humble request. With that, Nidhi and Deepa, let me begin with a snapshot of markets. Okay, so where do we start with? Well, the slide which I have shows you exactly 1 year data. Like we started September 22. And if you see the lines here, there are slightly, I would say some lines are faint, some lines are red, and some lines are dark. Let me explain to you what these lines say. So you just look at the red line. The red line is the Nifty 50. In very simple terms, the top 50 companies listed in the Indian equity markets basis their market capitalization, right? So top big 50 companies in India, and that is usually a benchmark. We also use Sensex as a benchmark to show how the equity markets have behaved. So last 12, 13 months have not been easy. Now, this is very cliched because I always say that, when I begin, every year, you can't predict markets. Sometimes they surprise you on the upside. Sometimes they surprise you and shock you on the downside. In the last 12 months, you have seen a lot of volatility. If you see the initial part, and Nidhi, you can just trace, from September till February, the red line. Yeah, this part from September till February, the beginning part, the initial part. Yeah. So if you can see, this is a little bit, I would say, a non-event. It's a flattish line. The reason is that interest rates started going up very early in 2022. In fact, in December 2021, the US Fed was very clear that the party is over and we need to increase interest rates because inflation is becoming a big, big threat to us. So September 22 onwards, which means last year, the world did not have a clarity. The world felt that interest rates will continue going up, right? There is no respite and things will keep becoming expensive because we all know that if interest rates go up, borrowing costs go up, inflation is anyway high, and it bores a hole into our wallets and our pockets and our purses. So when interest rates go up, when the mood is that interest rates are not going to come down, you don't find stocks, you don't find companies, you don't find equity markets rewarding you. So they are kind of morose, they are kind of a little, I would say, or depressed, which is what Nidhi just traced, which happened from September to February. Now, Nidhi, if you can just trace from March onwards, you can see a turning point, right? You can see markets actually climbing, sharp recovery, okay? And especially if you see July onwards, it's really jumped. So all the graphs jumped. Your Nifty 550 jumped, your black line, which is the 500 stocks, jumped, and of course your gray line, which is the mid cap. If you can see the dark gray line, that also jumped. So what changed? What happened? We have not seen interest rate cuts anywhere in the world, right? I think a couple of things happened. One, there was a realization that interest rates will not continue going up. So across the world, whether it is our own central bank, which is Reserve Bank of India, whether it is the US Fed, whether it is the European Central Bank, the Bank of England, they all started giving these vibes, these these hints that interest rates will eventually fall. Now that eventuality, we are not in a position to state when it will happen. That's anybody's guess. The central bank governors know that. Maybe they also don't know it because they're also tracking developments. But the view came, and it was a consensus view that interest rates will start falling, which means that we are very close to the peak. Now they can fall in mid 2024. They can start falling in end of 2024. As I said, it's guesswork right now. And if you consider the market reaction, it's completely opposite, correlated in a very opposite manner to interest rate movement. So the moment the world starts feeling that we are peaked and interest rates will start falling, that's when markets start recovering. You also had some kind of a respite in oil prices. Inflation in the world started coming down. That's very important. So we were hearing about some very, very preposterous numbers across the world. US inflation was beating 7-8%, numbers which we have not even heard in India. I think UK and European inflation, and some of you, spend some time on those shows being merchant navy employees. And UK and Europe inflation was 30-year, 40-year high. All that started coming down, which is the output or the outcome of interest rates going up. So as a result, we started seeing markets recovering, and there's been a very sharp recovery, ladies and gentlemen, in markets from Feb, March of 2023 till probably August, September of 2023. Yeah, so that's just a kind of a brief roller coaster ride of equity markets in India in the last 12 months. Nidhi, next slide. Okay. So I've already covered this. I don't want to go through the fine print on the top. I've explained to you that what has happened in the past. So from a US perspective, I think the economy has grown at 2.1%, and the Fed holds rates but has warned of more hikes. But we feel that maybe there are a couple of more hikes to go, and next year you will see a stalemate. So there is this theme about higher for longer. You will see interest rates slightly higher, maybe some more length of time, but eventually, maybe second half of next year, you will start seeing noises around interest rates coming down. On the domestic front, I think the economy in India has been very, very resilient and very, very strong. Good news for all of us. In fact, India was recognized as the most favored equity destination just about a couple of months back by an international analyst firm. And this is a very strong and a very commendable title to be given to our markets. And it's no guesswork and no brownies for guessing why, because we have been very strong on the deficits. Our fiscal deficit, the twin deficits, the trade deficit, fiscal deficit, current account deficit, I think all of them have been under control. Inflation, which was breaching 7-8% a few months back, is now come down in a range which is very close to maybe RBI's comfort zone. We are still not out of the woods. We are still above 5 or 6% inflation, but still we are still not at 8 or 9%. Maybe we were threatened to go. So that's good news. Prices are cooling off in India. You can see some numbers here on your right at the bottom. Nidhi, if you can just give a cursor on the indicators, current and previous. So you can see most of the indicators over the last maybe couple of months have improved. Exports obviously have taken a hit. That's something which is gray, and that's also to do with the geopolitical situation. A lot of countries not importing from India, and of course global growth slowing down. We are not growing at the pace that we were growing probably in 2021 or 2022, right? But if you look at tax collections, have a look at that, ladies and gentlemen. Record collections from an income tax perspective in India. More and more people are giving taxes and they're paying higher taxes to India. So big plus. Look at the industrial growth. I think that's very, very heartening. In 1 month, from 3.7%, industry is now growing at almost 5.7%. And on the left-hand side, that's a very important chart, a mother chart. If you look at all economic indicators, you can see this is the GDP growth rate of India. So we did have a slump, and that slump, Nidhi, you can point out, was 2020, 2021. I don't want to defend India because we were still relatively better than the rest of the world. That was the dreadful COVID period, and thank God that period is over. But barring that, have a look at the recovery, very sharp recovery. 9.1% growth in 2021, 7.2% growth rate in 2022, 2023. And again, if you look at the global estimates, which come in from the World Bank and IMF and many other agencies, India should grow, grow more than 6% for the current financial and calendar year as well. So India is a light, a light at the end of the tunnel. It's your knight in shining armor. And I think this is one of the top economies which the world is looking at in a very, very favorable manner. Nidhi, next. Okay. Now I'll try to take the bull by its horns, because I'm sure this question will come in. Maybe Deepa will have this from some of our customers later on. I just mentioned that the markets have rallied sharply in the last 5-6 months. That's true. But now the pressing question and the pressing concern is, should we invest now? Are the markets too expensive? And There is a rhetorical way of answering that, and there is a methodical and a data-backed way of answering that. I'll keep the rhetorical way of answering maybe when Deepa asks me questions. Maybe let me just point out to the two data charts which are there on your screen right now. Ladies and gentlemen, have a look at this. So on the left-hand side, you have a very popular indicator called PE, price earning ratio. Most of you would be familiar with this, but for some of you, some of the uninitiated, where a lot of jargon kind of perturbs you, I'll try to simplify this. Price to earning ratio in a very simplistic way, in a very colloquial manner, is how the market perceives the price of a stock or an index. Do you feel that the price of a stock is very, very high as compared to the earnings or the profits or the revenues which this company will generate, right? So then the PE is very high. If the market feels that the price of the stock is not run up in line with its earnings, it is trading at a discount, then we say that the PE of the market is low. Yeah. So in basic terms, what does the world think about India? Is it expensive? Is it cheap? So have a look at what we have shown here. The dotted lines, and I'll just show you the red line. Yeah. I'll draw your attention to the red line. The dotted line is the average price earning index of the Nifty 50, which we spoke about. And we have taken period from 2009 to 2023. So we've covered 14 long years. Yeah, and you can see the average is close to about 18. Yeah, so that's the red line. And if you see the prices today, yeah, if you see the prices today, you can see that the price would be close to about 24 or 25. Yeah, so I think what has happened is, and this is slightly dated, we have latest data which shows that in the long term, the average price earning ratio is not very far from where we are trading today. So which means that if the markets were expensive 10 years back, today also they are expensive. If the markets were reasonably priced 10 years back, today also they are reasonably priced. So we are in line with relative earnings. We are right with the long-term average of the equity markets. Same thing you can see in mid caps. In fact, if you look at the mid cap, we are actually trading at a discount to the long-term average, right, Didi? So the gray line, the gray dotted line is typically your on the left-hand side, the price earning, the PE ratio. The gray dotted line is your mid cap price earning ratio, and you can see the solid gray line, which is the current price earning ratio of mid caps. It is lower than the average. So what I'm trying to tell you here is how do you interpret these charts if you just cut the jargon? India is a country where a premium is attached to stock. A premium is attached to the quality of companies and the quality of earnings that these companies make. I don't feel, and we don't think, that India will ever come cheap as an economy or as an equity market in the future. We are among the top 5 economies. The writing is on the wall. We'll probably be in the top 3 sooner than later, right? Japan and Germany is just a matter of time before we beat them on GDP. And that is the perception about India today. So India will not come cheap. If you are getting a good entry point today, from the next 5 years, 7 years, 10 years perspective, we feel that earnings are going to grow. Earnings are very strong in India. Some very quality companies, both Indian and international companies, are setting up bases in India. They are expanding. And anytime, whether today, whether yesterday, whether tomorrow, will be a good time to take a long-term position in Indian equity market. So they are not expensive. They are not cheap. They are reasonably priced, and they will be remaining expensive in years to come because we are a quality economy now. Right, Nidhi? Probably we'll have one more slide to cover, and then we can take questions. Yeah. So this is what we also call, this as the Buffett indicator, named after Warren Buffett, the greatest investor of our current times. Hats off to the man. So what is this? This typically tells you about what percentage of the GDP is the stock market valued at. So is the stock market running ahead of our economy? Then there can be a problem, right? Which means that the markets are expensive. Is the stock market in line with the GDP? Are the stock markets priced in line with the GDP? Which means then that we are okay to invest and the economy is just moving in tandem with the stock prices. Or are we lower? Are our stock markets, are our equity markets lower than the way the economy is growing? Which means that there is some kind of a discount being offered. The GDP is growing at X and we are growing at X minus something. The stock markets have not yet caught up. So you can see here, this is the history of India, market cap to GDP, right? So across 2011, since 2011 till 2022, It's only been once that we have probably run ahead of our GDP. And Nidhi, you can point it out. I think this is the financial year 2022, where the market cap to GDP was 103%. Today, we are somewhere about 95, 96%, which again makes me come to the point that uh, equity markets are running in line with the expectations of the GDP. We are not exorbitantly priced, and for no reason, foreign investors are finding it. The FPI money, the FDI money, which is coming into India over the last couple of years, is probably in record numbers and record flows. So I think with this, Nidhi, we've reached to the end of the presentation. I think that's where we are. And before I request Deepa to take your questions, just to summarize the market outlook, India is shining right now. It is a sweet spot in the global economy where world is talking about recession in some parts. There are geopolitical tensions happening in various parts of the world. India is still showing a lot of resilience. We have shown a lot of resilience. India is getting a lot of inflows both from domestic investors as well as from international investors. Domestic investors are now almost equally partnering the inflows and the confidence which earlier foreign investors used to show in India. There's a lot of action happening in India from a policy perspective, from reforms perspective, from infrastructure perspective. We've seen it around us, whether we are living in Mumbai, Delhi, or maybe tier 2 and tier 3 cities. And I think from a valuations perspective, we should not get scared and we should not get swayed just because there's a number which says that the price earning ratio or the price to book ratio of the market is very high. If you follow the earnings, if you have faith in the good companies and you know that they're going to grow at a certain level, today can be as good as a time to invest as maybe it was maybe 5 years or 10 years or 15 years back. So this is a summary statement from me. And Nidhi, Deepa, I would request you to encourage investors to pose their questions. The next half an hour we can take their questions.
Thank you, Rajat and Nidhi. That was indeed informative and encouraging. While you both were sharing your expert guidance on the financial wellness, we have received many interesting queries from our viewers. So let me ask you some of the questions which have come across. The biggest question in all of our minds today is on the current geopolitical situation and how is that going to be impacting Indian stock markets or Indian markets in general?
Yeah, I think that's a very pertinent question, Deepa. Thank you for asking that, and I'm sure our customers who are there on the call are there. Just one more reiteration. I would request your questions to remain general in nature. Anything specific to products or any personal requirements on finance, I would request you to contact your relationship managers. I believe there's a number which is flashing on the screen, so please reach out to the bank and you can have a personal discussion. But yeah, this is a general question, Deepa. Thank you for that. So yes, we have been facing geopolitical situations since World War One. Let me put it across in a lighter way. It is a serious issue. We can't trivialize it. We had the Russia-Ukraine war, which surprised us just when we felt that we were getting out of the woods, when we were recovering from the second and the third waves of COVID. Right, that shook the world. And when that headline from page 1 went to probably page 3 and page 5 and page 10, now there's not so much news and so much concern about Russia Ukraine. Now we have the Middle East crisis, right? So which we've seen in Israel and neighboring countries. So I think if you look at equity markets, they do react. Equity markets are ultimately based on fundamentals, but sentiments do play a role on a day-to-day basis, right? So if you have somebody hitting someone in the world, somebody bombing someone in the world, equity markets will react, whether it's US markets, it's Chinese markets, or it's Indian markets. Having said that, if I draw a line and draw a graph from World War One, World War One is just an example, but the Sensex came into existence in 1979, right? So we've had more than 40 years of a glorious history of the Sensex. I will not have those many fingers that I can count the geopolitical crisis that you and I and maybe our seniors have experienced. Sensex was at 100 points in 1979. In spite of all the pitfalls, today we are at a 60,000 Sensex. Yeah, so that tells you the resilience of stock markets. That tells you that the permanence of wealth creation comes in from longevity, right? You will have these hiccups. In fact, one should look at these hiccups as probably points to enter. Whenever you see a global crisis, somebody has said this, right? That there is always an opportunity in adversity. In fact, if I'm not wrong, the word crisis in Chinese means opportunity, yeah, or somewhere close to opportunity. Pardon me for my loose, hang of Mandarin, but that's what it is. So I don't think these things last. Uh, I'm not a geopolitical analyst. I'm not somebody who can probably even try to think about when this crisis will end or whether there is a risk of conflagration. But in spite of if trends are our friends, and if you've seen what has happened in the last 10, 15, 20 years, then this too shall pass. If you're finding an opportunity right now, you're seeing markets correct a little bit from their all-time highs. We are still not 60,000. We are about 59,500. We're still not 20,000 on the Nifty. Deepa, we are still somewhere less. We should take positions because ultimately prices follow profits. If your companies are making profits in the long run, 5 years, 10 years, 15 years down the line, they are good, solid companies, then these events will not matter in the long.
Thank you, Rajat. That gives us a lot of confidence. Rajat, the next question is, which many of our mariner clients are asking is, the nature of the mariner segment is that they are off land for quite a significant amount of time with no access to, networks, etc., right? Because they are on the ship that time. So, what is an ideal asset investment source or class that they should do before they go on ship and when they are not there on land for quite significant amount of time?
Yeah, I think that's you mentioned that it's about mariners and shippies, and I have a lot of clients. I have a lot of friends who sail throughout the year, 4 on, 4 off, 3 on, 3 off. So I understand and I appreciate the difficulties which shippies and their families face. It's a difficult life, but at the same time, I don't think it would be prudent for us to generalize asset allocation or investment advice for everyone. Deepa, as I mentioned earlier also, to the disclaimers, I think this is a personal discussion. Generally, as a rule of thumb, I can share, and this is not true only for mariners, it is also true for every other individual who wants to do financial planning or asset allocation. I think one needs to follow asset allocation at any given stage of life and time. That's very critical. One should not have all eggs in one basket. Little bit of fixed income, little bit of bank deposits, little bit of real estate, a little bit. We are overly invested as a country. We all know that. A little bit of equity, and that little bit depends upon your risk appetite. Like Nidhi mentioned in the beginning, it depends upon your stage of life and your ability to earn, and also what is your goal and what kind of goals do you have coming in and what stages of life. So for someone who's very young, maybe at just starting about 25, 30 years of life, then equity asset allocation should be still higher than fixed income. These are all, again, we are not giving advice. These are all rules of thumb. And I would again insist that please have a formal session when you come into India, when you meet your relationship managers on financial planning. I think HSBC has a brilliant system, a very scientific way of devising your financial plan and gauging your risk tolerance. So please, I would encourage you to go through that. But as we go slightly higher in our lives, when most of our goals are achieved, when we are closer to retirement, then you need to look at less volatile, less risky assets as well, which means a little bit of fixed deposits, a little bit of debt, some real estate, gold, all those things coming. So, but I think one thing is very clear, and Deepa, I don't think there is anyone who will say no to that. It's about investing regularly. Whatever asset allocation you decide, you should be in a very disciplined way investing that. Keep reviewing your asset allocation because asset allocation keeps changing. Yeah, it's like I mentioned in the beginning, it's a myth that you can design your financial plan once and sleep over it. It changes with the stages of your life and the dynamism which your life demonstrates every now and then.
Yeah. So a follow-up question to that, and I think you already answered to that, and but this must be there in many of their minds. So I just want to call it out that they can't do daily stock trading or daily trading, right? Or they can't review their portfolio on a daily basis like a normal resident client could do, right? So what the question is reading is that So how do they monitor their investments? So, what is the periodicity of monitoring the investments that you think ideally? Because 6 to 9 months is when they're not there. So, because you did say that you should keep regular monitoring. So, is it okay to monitor it once a year, or do you think they should do something differently?
Yeah, that's a good question, and I completely appreciate the fact that when you are sailing in international waters, it becomes very difficult to catch networks, and at times, you don't have access to networks. So this is a very valid question. Now, there's a difference, Deepa, between trading and investing, and like Nidhi alluded to, the difference between savings and investing. I think there's also a big difference between trading and investing. If you are a trader, which means that you want to buy stocks, you want to buy bonds, you want to buy gold commodities day and probably sell the next day or within a few days and bag that profit, pocket that profit, then of course you need to be worried. Then you need to be on the job, you need to have the screen sticking and flashing in front of you. And I completely appreciate the jitterness, the jitteriness when it comes to that, the jitters. But if you are an investor, your investment plan would have various buckets if it's been made and curated in a very thoughtful and a scientific manner. You will have a short-term goal, which will probably be 6 months, 1 year down the line. So you'll have some money kept in that, and that money cannot go into risky assets, which you need to monitor every now and then. That money will go into something which is less risky. Also, risk and return are the two sides of the same coin. So low risk also means you have to compromise and settle with a lesser return. So maybe liquid funds, bank deposits, something which has very little volatility and very slow or relatively lesser margin of going wrong or losing capital. Then you come with slightly medium duration, which means if you have a goal for the next 2 to 3 years, that can be anything, child's marriage, education, you want to probably buy yourself a vacation with the family. So for that, something which is slightly riskier than something which you would need in 6 months to 1 year, and that can also be planned. And then finally you will have something which comes in after 10 years or 15 years. We all do, Deepa, right? So it's all about bucketing, and that last bucket is something which you need to, so it's like 80% of the effort goes into sharpening the axe, so that only 20% of the effort is required to cut the tree. So if you're planning it well, then you don't need to review your plan, your financial plan or your investments every 2 months, every 3 months. Good mutual funds, good portfolio management schemes, which are advised by qualified advisors, which are recommended by good reputed institutions with a lot of research capabilities, just like HSBC. I think that's where you can sleep easy. You don't need to jump on the ship to get that 5G or 4G network, those signals. And maybe once you come on shore, and that can be twice a year or thrice a year or once a year, you can have a chat with your advisor, your planner, and review your portfolio.
Thank you, Rajat. The next question, you did, speak about interest rates and how they are related to markets. So, what is your view? What is your view on the future of interest rates in India?
Yeah, and India is not completely unplugged. India is plugged into the global flows, and we also have to match rates and keep a queue on what is happening to global interest rates. So I already alluded to that, Deepa, but since this question is coming up from some of our customers, I will repeat the view that we have, and I'm giving you a house view, the HSBC Asset Management house view, is that interest rates have gone up significantly in India. They have gone up significantly across most of the developed economies, US, UK, Europe, Southeast Asia, over the last 1.5, 2 years. We feel that we are very close to a peak. Again, it's very difficult to decide the bottom end peaks in economic in capital markets, be it equity, be it debt. Having said that, if you see interest rate cycles in India, usually they follow about 18 to 20 months, one cycle. So if there's a hiking cycle, it usually stops after 15 to 18 months. If there's a softening cycle, that also usually changes or stops after 15 to 18 months. So we feel with all this confidence and all the data which we are getting, we are very close to the peak. Sometime next year, who knows? Very difficult. I'm not a soothsayer, but sometime next year, second half, end of next year, you should see some positive signs on softening. Whether it's in India or in US, time will tell. But that is a view.
Okay. Rachit, we all know how elections have impacted markets in the past. So, what is your view? Should the people who have not yet started doing investments, should they hold on till May 2024, wait for the election results, or you think we can start now?
Wait for what?
Wait for the
Wait
election
for what?
results. Election
But
results.
what will the election results do to equity markets? What will it do to somebody who's investing for the next 10, 15, 20 years, right? And I'll give you a very simple analogy to this, Deepa. Uh, we have seen how many 17, 18 general elections since
Yeah.
India got independence, right? Every 5 years there's been an election, and of course there have been some interim elections as well. We have been having so many state elections as well. So many states, and every state goes into election. So I think this is a part and parcel of life. This is business as usual. Of course, a lot of TRPs come into media companies. I'm just taking it to a lighter note. Media stocks do well because you have exit polls, you have opinion polls, and a lot of these guys make a lot of money. Advertising, the sales budgets go up. But on a serious note, elections, just like I mentioned about geopolitical events, I think elections are also passe. They are also, passing events when it comes to wealth creation, when it comes to companies making profits and that profitability reflecting in the stock prices of those companies. We've seen so many elections. We have seen so many political parties come into power, so many coalition governments getting formed. But ask the investor who has invested 20 years back, 10 years back, 5 years back, 30 years back, he or she is smiling, right? Because no other asset class would have made more money for that investor as compared to equity markets. So I think it's all about sentiments. Yes, there are nerves. Yes, when the outcomes are announced, when there are exit polls or opinion polls, you do see the Sensex or the Nifty fluctuate, which is the human nature of markets, right? In markets are made when you have people of differing opinions. You have a buyer who has a view, and you have a seller who has a different view. You can't have everybody having the same view in the markets forever. So these sentimental changes in the markets do affect. We are expecting one thing for sure. I cannot I cannot comment upon who will come into the center or who will win the state elections as we are getting into election season. But one thing is for sure, that you will see volatility. And when I mean volatility, I mean fluctuation. You will see a down and you will see an up and you will see a recovery. And that, I think, is a sign of a very good, healthy equity market, be it India, be it US, be it China. So volatility is, we usually say that volatility is a friend of the fund managers, right? So if a fund manager finds volatility, he or she gets that opportunity to buy a company at a good price. So I think elections are overrated when it comes to assessing or expecting market impact. One should just go with the flow. Whether one should wait for elections to happen, uh, I don't think waiting has ever benefited anyone, because you just don't know. If you are investing for the next 6 months or 7 months, and that is the time when you will see a new government, a new formation of the government, uh, then definitely equity is not for you, because equity markets and equity investing is usually 5 years, 7 years, 10 years, is long term in nature, and that's when you actually are able to taste the fruits of wealth creation. But if you are looking at 3 years, 5 years, 10 years, then elections now, investing now or investing after the elections should not matter. What matters is, when you have the money, you should invest. When you have the surplus, you should invest. You should invest basis good advice. You should invest basis good research, because ultimately the mutual funds, the portfolio schemes, the stocks which you are investing in, if they are fundamentally strong, then doesn't matter how many elections come in the long term, you'll always be a winner.
Yeah, makes sense. Absolutely. Rajat, you also covered on how we should prepare for our investments, keeping in mind inflation, right? So, do you think that the inflation will now come down or will it remain stable? What is your view on that?
Deepa, I think the inflation has already started coming down significantly, and I'm not even talking about India. I'm talking about the global inflation, right? So please understand. I think everybody knows that we're all. I think all our merchant navy customers on this call are very experienced, and they have, I'm sure they would be having investments abroad as well. So I think inflation there is a domestic inflation and there's an imported inflation in India. Yeah, so both inflations are coming down because globally commodities are losing value. They are dropping in prices. What the prices were maybe 10 months, 9 months back, they are much lesser now. Hard commodities, soft commodities, metals, oil. In spite of all the geopolitical crisis and drama that we have seen in the Middle East, oil is not ballooned the way it used to. Maybe if you recall the Gulf War 20 years, 30 years ago, and all those crises which used to, hit India a lot. So we are cooling off. I showed you a slide on inflation, how it is coming off slowly and steadily. I think RBI's comfort zone is below 5%. Maybe in the next 6 months to 1 year, we should see inflation cooling off further, unless there are global events, geopolitical events, which spike up commodity prices.
Okay. Rajat, what is your view? We always have this in mind, equity versus real estate, right? So many of our young mariners, they're asking, should we invest in equity mutual funds first, or should we first buy a house? What is your view as an investment option? Real estate as an
It's
investment.
a very interesting question. It's like, I have a sweet tooth. Should I eat an apple or should I eat an orange? It's difficult to answer. I think both asset classes have their own benefits. I'm not being politically correct or diplomatic. I think I'm giving you a fair answer. Both asset classes have their benefits. Both asset classes have their nuances, their challenges in India. We all know about how difficult is it to deal with real estate, especially when you're not living in that. If you're buying it and holding it or renting it in India, or you plan to sell it. We also understand that real estate is stable, so it has its benefits also. Very seldom do you have a threat of losing capital in real estate. But at the same time, it involves a big allocation of capital. Real estate is going up in India since the last 70, 80 years, and the trend is upwards. But having said that, if you consider equity, equity also has its unique benefits. Yes, it is more volatile in real estate. I agree. In the shorter term, you will not see a swing of plus 20 and a minus 20% in real estate in 6 months, but we've always witnessed these kind of things once in 5 years in equity markets. But having said that, you don't need millions and billions of dollars to invest in equity markets in India. We all know that you can start with a very small amount through a systematic investment plan, a very small portion. You can do that in your children's name, in your spouse name in India. Also, liquidity in equity is much better than in real estate. Equity markets are very liquid in India. You can sell your stocks, you can sell your mutual funds, and the money comes in a couple of days, 2 to 3 days, and it's very transparent. Within a minute, every minute, you know what is the stock price. Every day, you get to know what is the net asset value of your mutual fund. So all I'm saying is that both asset classes individually have their merits, they have their challenges. Please go back to asset allocation 101, which means that some portion needs to be allocated to every asset class. Now, that depends upon the capital, that depends upon your risk tolerance and what stage of life you are in. But Deepa, just a word of caution here. I think as Indians, we are overly exposed. I'm not talking about the audience here, I'm talking about public in general. We are overexposed to physical assets. When I say physical assets, I'm talking about equity, I'm talking about gold, I'm talking about silver, I'm talking about real estate. So maybe one needs to just do introspect a little and figure out if there is a way of balancing the asset allocation and maybe making it a little bit equitable.
Okay, got it. Rajat, one on mutual funds is a mutual fund with low NAV better? This is what people are asking, that will they grow faster than a mutual fund with a higher NAV, net
So that's
asset
a,
value, basically?
yeah, and so there is something called optics and there is something called reality, right? So I think this is optical. For example, a new fund offer comes in and it starts at 10 rupees. We all know that, right? Every new fund offer, a new mutual fund scheme launches at 10 rupees. But is that 10 rupee mutual fund scheme cheaper or coming at a discount to a mutual fund which is running for the last 5 years, which has an NAV of say 18 rupees? I'm just giving you a hypothetical example. The answer is no. It may be, but just because it is at 10 rupees and something is at 80 rupees doesn't mean. And just to explain that, if you look at the composition of a mutual fund, what is the composition of a mutual fund? The composition of a mutual fund says that it reflects the prices of the underlying companies. I'm talking about an equity mutual fund here. It reflects the prices of it's a weighted average of the prices of the stocks which that mutual fund, trust, or unit or vehicle is holding. Yeah. So even if it is 10 rupees or 15 rupees or 18 rupees, it will reflect the underlying prices of the stocks. So just because the mutual fund NAV is at a lower level, A mutual fund NAV is 10 rupee, B mutual fund NAV is 15 rupee, that should not be the reason for you to lap up the earlier mutual fund. One should look at the underlying portfolio. We all have access to fact sheets now, Deepa. They're all available across mutual fund websites, on the AMFI website. I'm sure HSBC also has access to their customers. They give access to study the composition, the portfolio of mutual funds. One should look at the nature of the mutual fund. Is it a small cap fund? Is it a mid cap fund? Is it a large cap fund? Because then you need to compare A large cap versus B large cap. What has been the track record over the last 1 year? A mid cap versus B mid cap. What has been the volatility? What has been the consistency of the portfolio manager? So I think all these things matter, which is why I usually say this, that you need experts, you need advisors, you need professionals whose bread and butter is to study mutual funds and then give you a correct comparison. So absolutely not. One should not look at the NAV and use that as a decision maker.
With this, we come to an end of today's session. Rajat and Nidhi, thank you for your time and valuable insights. I'm sure that our viewers have got some great takeaways from today's session. To our customers and the mariners who have joined us today, I hope this was useful. Do keep tuned in for further sessions in the future. In case you want us to take any special topic or share feedback, please do reach out to your relationship managers. For people who don't have a relationship manager, please connect with us on the SMS number which is there on the screen. We will get back to you. We will see you again soon for another interesting session. Have a great day and a weekend ahead. Thank you.
Thank you. Bye-bye.